Hey everybody, welcome to tonight's video and tonight's live stream. Thanks for tuning in from wherever you are, whether you're on LinkedIn, Facebook, or YouTube. Good evening, everyone. My name is David Aaron, and tonight we're going to be talking about a subject that I happen to know quite a bit on, and I hope that you're going to enjoy it. It's something that is actually quite unique. You know, the topic of tax-free income, so much so. People have seen tax-free associated with scams and really shady kind of multi-level marketing schemes. And what I'm really actually going to be showing you is that what the true idea around tax-free income is. And it's kind of interesting, tax-free income. It's income that's not taxable. And so that's the whole point of today's discussion. I don't expect for it to go very long. If you have any questions, please feel welcome to put those questions in the chat, whether you're on Facebook, LinkedIn, or YouTube. It aggregates them all into my software here so I can chat with you along the way. If you are hearing this okay, please give me a thumbs up that you hear the sound is okay and we can proceed with everything else. If you're new to the channel, please remember to like and follow. I'll just put some of this graphics up so you can see here. If you're new to the channel, head on over to the YouTube channel. All of my videos are on there now. I think we're like 65, 66 videos on a number of different subjects, whether it's about financial planning, estate planning, retirement planning, whether you're a business owner, an individual, or a family. These kinds of videos are going to make sense to you, at least I hope. My style is very direct. I try to make sure that I give you all the information in a simple and easy to understand way. So if you're new to the channel, please like and share and follow this channel so that we can share this information with everyone that needs to see it. Hi, Ivan. Nice to see you on the call. Ivan is all the way from the province of British Columbia. So really great to see you on the call again today, or on the video. Well, why don't we jump right into that? Again, if you have any questions, put your questions in the chat. I'm going to go through this pretty quickly and then get right to the meat of this presentation so we can get into the details, okay? So let's get my mug out of the way and then you can see what I'm looking at. Okay, this is actually going to be designed, if you will, for a number of different situations. And I'm going to sort of give you some backdrop so you can sort of understand the focus of what we're talking about. Let's say you're a business owner on the left. You can see this young business owner is rubbing his eyes because he's being charged 53% tax on the investments he has in his corporate account. I'm not talking about the income from the operation of the business. I'm talking about the business owner has money in a corporate account, investing it in either a mutual fund, segregated fund, GICs, bonds, whatever they're investing in, and they have to pay 53% tax on that income because it's considered passive income tax. So this type of business owner is thinking, it just doesn't make any sense for me to invest my money, 53% tax. How can I invest my money in such a way that I can pull money out of my company on a tax-free basis and use that? Every business owner wants to know, how do I pull money out of my business? Well, this video is for you today. What about the couple on the right? This couple may have some some non-registered assets, whether they had sold a business, inherited money, just did really great at saving money. Maybe they're real estate investors and they've got some non-registered investments and they're going to be probably in a situation where they're going to have clawback on their old age security. And so they're really focused on tax minimization and not being clawed back on their benefits. So there's a couple examples of who this video might be for. But if you're not one of those, it's okay, because a lot of this is going to apply to an individual as well. So here are some two guys here. What do they want? They want tax-free income, and they want to be able to live their life free of having to pay income tax on the money that is being put in their pocket every month or every year, and just enjoy retirement instead of having to worry about paying tax on every piece of dollar that comes in. So if you look at a traditional way of investing, a lot of people use RSPs. I'm not knocking RSPs. There's reasons for them and reasons against them, but you're going to lose 40% of your RSP balances because of taxes, either because of the withdrawals you make or at death when the final, so in the case of a husband and wife, when the money rolls over to the surviving spouse, and in the passing of that surviving spouse, you're going to lose about 40% of that to taxes. So just understand that when you have an RSP, you're actually going to have lose 40% of it. So try to spend as much as you can through your retirement, but at the end of the day, Revenue Canada is going to collect about 40% of that. Okay, so that's why I wanted to just share that with you. So there's very little tax-free investment. There are strategies to take your RSP and do a RIF meltdown, or do early withdrawals in your RSP, or do really complicated things like taking a non-registered investment like a loan and using the tax savings to offset the withdrawals. I'm not in favor of complicated things. I think there's so many things you can do that work without it being too complicated. Maybe you're an individual who is leaving the workforce, going to be commuting their pension, and you'll have a sizable amount of money that you probably have never had that amount of money in an investment account. And you're, okay, how do I invest this money? Besides how to invest this money, but you're also thinking about, well, how do I maximize my estate? How do I take this? Part of it is going to be non-registered, part of it is going to be in an RSP. But how do you maximize the amount of money you've been given in such a way as to receive more money later on in your life on a tax-free basis? So that might be something that, if you're in that situation, might appeal to you. What about downsizing? A lot of times, as people are approaching retirement or they're in retirement, they begin to think about, we don't need this big house. We should just downsize, buy a smaller house, or move into a condo, and put this money that we've got in this house towards a retirement. It's obviously a big thing, especially when you look at the home prices. Look at this. This is an illustration of just the Toronto market. This is, you can see all the way from 2005, basically, all the way to this year. And you can see where we had a couple downturns, but nonetheless, the market is up dramatically. You're looking at a 5-year in the Toronto market up above 42%. And so if you're thinking about your home as an asset for retirement, so let's say your strategy was you're going to sell your home in retirement and use that capital in a non-registered investment and just pull money from it every month. When you first started that thought process, you probably weren't thinking that it was going to be this amount of money, because home values have just exploded underneath your feet. And so you've got a lot more money in retirement to deal with if you've got a home to use as well. Okay, so let's get into what this is. It is actually using life insurance, cash value life insurance. Now, before you ditch and say, what am I doing? I'm not going to listen to life insurance. Just hear it out. It's only going to be a 15-minute presentation. Life insurance, can you think of another way? You can put it in the comments now or after, if you're watching it in the replay. Put in the comments other ways that you can get a non-taxable income stream. And you're going to be hard pressed to find a way to get a non-taxable income stream. I'm not talking about a passive income. I'm talking about non-taxable income stream. You're going to find it really difficult. Your home is probably the closest thing you can get to it. And it has, obviously, if you did a reverse mortgage or you sold your house and put the capital into a non-registered investment, you're going to pay tax on the growth. So it's not going to be the same comparison as life insurance. So I'm going to dig into this. It's going to be actually very informative. And if you have any questions around this, or if you didn't understand how I'm going to explain this, put your comments below, and I'll answer your questions. So let's just dig into this as an alternative asset class. This is actually the full slide, but I'm actually going to break it in half so that you can concentrate on the areas that I think it's important. So let's look at this top half. If you have, let's say, a business owner, money in your investment account, and you are in your corporate investment account, you're going to have to pay tax on the growth of that investment. And then it's also going to be taxable when you pass away. And the tax that you're going to pay in that corporate investment account, you're going to pay 53% passive income tax. The reason for that is because the money that you're investing is not going towards your operations. It's just outside of your business. And that's the new passive income tax rule. It's actually very depressing. It's a disincentive for you as a business owner to invest your money inside of a corporation because of that, especially if you're not high risk and you're in a bond portfolio getting 4%, maybe less, and you have to pay 53% tax. Inflation, they just came out in Canada with inflation at about 6.5%. So it's really not a useful way for you have your money in your corporation. The other ways, if you look in some of the other videos, I'll put a link in the description on YouTube after this video. Your lifetime capital gains exemption, depending on how your corporate structure is, you could really be messing around with your lifetime capital gains exemption, because that is probably putting you offside to use that. But I don't want to get too far ahead, but let's just stick with this. So typically you're going to have your insurance or your accountant tell you to pay yourself a dividend each year. And in this case, that's what we're doing on the left-hand side. We're paying an annual dividend. And then when you pass away, everything becomes taxable, and that money is going to be given to your beneficiaries. So that's how a typical investment works for a business owner. If you're not a business owner, you're individual in a non-registered account, very similar, except the 53% tax. Unless you've got a lot of money there, then you could be paying that amount. But essentially, you're making a return. You pay tax on the growth of that investment. When you pass away, the accumulated value is going to be taxed to your estate. And so you're losing quite a bit of that money that you're investing. So let's look at the next slide. If you're using life insurance, I'm going to share this with you in two different formats. This format is really just showing you sort of like a visual representation of what I'm going to dig into in the details. And the next step, if you will be the actual math, showing you the real value. So we're not making any of this up. I want to share everything with you. If you like what you hear so far, give me a thumbs up. Remember to like and share this with everybody that needs to see this, because I think this is a pretty straightforward explanation about how to use life insurance to produce a non-taxable or a tax-free income stream in retirement. Okay, this is the first slide, and I'm going to blow it up so you can see what we're looking at. But essentially, this is on your left side is the investment, like in a mutual fund or segregated fund in a corporate account. And the right side is using a corporately owned cash value life insurance policy. So let's go just to the left and see how that looks. On the left-hand side, you see those two areas that are marked in red. The first column on your left, that's your annual dividend. So imagine you're putting in $50,000 a year from age 45. And in this example, I'm showing you doing this for 20 years. So that at 65, let's say you retire and you sold your business, whatever that might be, and you decide, now I want an income stream. So that's the whole point of this, right? So you're taking money, just so I can make sure you all understand this. We're taking money from your corporate account and you're transferring it to a corporately owned life insurance policy, and you're depositing that inside it. So you're just making a deposit. The money is still there. You're just making a deposit, taking it from your corporate investment, which is taxable, to the life insurance, which is non-taxable. If you are not a business owner, you're taking it as an individual, you're taking it from your non-registered investment account, which you probably would have had in like equities and fixed income. This would probably be just your fixed income portfolio because it's the low return, low risk. It's comparable to the life insurance. So you would take that amount of money and transfer it into the life insurance. So let's use the example of $50,000 a year, okay? And so on the left-hand side, $50,000 a year, and you can see that at age 65, you're able to pay yourself in a corporation. If this was your corporation, not insurance, just a corporate investment account, you're going to pay yourself an after-tax dividend of $107,000. Let's just call it $108,000 because it's a few dollars shy of 108. So you're going to pay yourself a after-tax dividend of $108,000, and you're going to do that for as long as you possibly can. That's going to last you until age 71, and then at age 72, you don't quite have 108. It's about $40,000, $40,000. So you actually run out of money in your corporate account. And you can see that on the second column, there's the investment balance. You can see it running up. So when you're about 65, you have $1.1 million in your corporate account for you to tap into. Now, let's use the same example, but using the corporately held life insurance policy. 2 columns. On your left column that's in red, the same withdrawals, except what you're doing here is you're going to a financial institution and you're pledging the cash value of your life insurance as collateral for a loan. And you take a loan every single year. And a loan is not taxable. It's a tax-free amount of money. You ever go to a bank and take money from your line of credit? You don't have to pay income tax on that, do you? Well, same is true here. So you're going to pull $108,000 as a loan each year. And you can see that now you owe $108,000 to the bank, but you don't care. And the reason is because this is life insurance. It has a death benefit. So there's cash value in life insurance. You're okay. You've got enough cash value and you've got a death benefit. So if the worst of things were to happen, the life insurance would be there to pay off the loan. But look what happens. Remember in this first example, we ran out of money at age 72. But here in the life insurance, well, guess what? You're still pulling money out at age 72. In fact, I'm running this out to age 90 just to prove a point here for you. You've deposited $1 million over a period of 20 years, but you're pulling out $2.8 million tax-free out of your life insurance policy. You ran out of money a long time ago in your corporate account. You ran out of money at age 72 in your corporate account, but in your life insurance, you just kept transferring the money, let it sit there, let it grow. It's going to get about a 5% dividend. That will likely go higher as interest rates go up. Usually insurance companies raise their dividend. But the idea here is you're just letting it compound and grow. And then at age 65, say, you know what, now I'm going to start taking that money. Well, you are now taking out over a period. And this is just an example. You don't have to pay it for 20 years. You can pay it for 10 years. It's really, you pay for 7 years. You could pay for 15 years. You could pay the rest of your life. It all depends on what your strategy is. But in this particular example, I'm showing just a $108,000 loan coming out every single year. And so over a period of 26 years, you take out $2.8 million. Remember, I really want you to focus on this. This was money that your corporation had that transferred to a life insurance policy that you paid zero personal tax on. And then you pull the money out of the life insurance and you pay zero personal tax on that. This is absolutely getting around Revenue Canada. They know it. It's not illegal. It's a perfectly legal way to use life insurance in a corporate environment. And you're pulling out $2.8 million in cash personally without paying 1 penny in tax. This is the most powerful way for you to generate not just wealth, but to generate a tax-free income stream to you in retirement. And in this case, I'm being very specific about the times, being 26 years. And so I'm showing age 90 on purpose, well past the average mortality rate, which is about age 86 in Canada. So what I'm really sharing with you is at age 90, let's just have a look at what happens. Let's assume that the person passes away at the age of 90. You can see here that they've taken $2.8 million in cash. They have a loan that's about $4.8 million, but I'm just trying to see the values. It's a little bit hard. No, they have a loan that's about $4 million, and their life insurance death benefit is much higher than their loan value. So what ends up happening is that the person passes away, the life insurance pays off the loan value, and the remaining amount goes to the beneficiaries. In this case, $1 million is going to the beneficiaries. So you put in $1 million of your corporate cash, pull out $2.8 million, and send $1 million to your beneficiaries when you die. Can you think of a better investment to use $50,000 a year in your corporate account, or to use $50,000 in your non-registered account that you would have put in a bond portfolio that's slow and it's not making in very much money and it's painful because of the interest and the tax you have to pay on it? Can you think of a better alternative for you to use $50,000 a year? This is closest thing to this is real estate, that you could put, $100,000 down on a property and then have something that might pay off 26 years, much more than that. So this is the power of using life insurance. And so many people ask me, why would I put so much money into life insurance? Why would I put $50,000, $100,000, $200,000 a year? Because you can see this is what life insurance, cash value life insurance produces well into your retirement. This is not universal life. This is whole life, participating life. Universal life works a different way. So if anybody pitches you this strategy using universal life, understand that they're not using the right product. That might be the only product they have to sell. You can actually use universal life, but you actually have to lower your rate of return in the universal life policy in order to get the loan at 90%. So participating life or whole life is what you want to use for this strategy only, no other product. And if you put money in like this every single year, that cash isn't gone, the cash is available for you whenever you want, but I'm just showing you a way to use it later on as a non-taxable, a tax-free income source for you in retirement. That's it, guys. Can you believe I'm all done? 21 minutes. I hope that you found a lot out of this. This is the idea of why I like talking about these kinds of subjects, because dollar for dollar, when you look at putting money in one type of investment versus another kind of investment, it produces dramatically different results. And, I manage money on behalf of my clients. I'm an active advisor. I'm not somebody who just does videos. I do financial plans. These financial plans, other companies charge about $5,000 for. I don't charge for my clients. That's free for my clients. When I'm doing financial planning, estate planning, that's all involved in what I'm doing. So they don't have to pay $5,000 to get those answers. But you can understand the value of having different alternatives. The motivation behind somebody saying, here, you should put your money in a corporate account. If you have somebody that has, multi-license that can say, here are the different ways you could invest your money and the outcomes and the tax situations and how that might achieve your goals, that's a very powerful way to do planning. And so I encourage you to get with someone who can give you that kind of detail and that many options in order to just manage your wealth in a very tax efficient way. I'll leave you with this. If there are no questions, because I want to make sure I'm looking at the questions here, and I'll leave you with this. We take care of your wealth management so you can take care of what's most important to you. Here's my contact information. Remember, if you have any questions, put your comments. I want to hear what you have to say about this particular strategy. I know that for some people, it can be a very controversial way. Oh, life insurance doesn't work. I've been using it for more than 20 plus years with clients. It absolutely does work. So put your comments below. I look forward to your comments. I'll reply to them as soon as I can. And again, thanks again for taking the time out of your busy evening for tuning into this live stream. I look forward to seeing you next Wednesday at 7 o'clock. And be sure to tune into my YouTube channels for all the other videos on all the various subjects. Thanks again for your time, and I look forward to seeing you again soon. Thanks. Take care. Bye-bye.